In 1907, the American financial system came dangerously close to collapse. Not because of war, not because of recession, but because of a stock gamble. The man at the center of it was Fritz Augustus Heinz. He wasn't a president, he wasn't a central banker. He was a copper entrepreneur who believed he could outsmart Wall Street. At the time, copper was one of the most valuable resources in the world. Cities were electrifying, industry was expanding, demand was rising fast. Control copper, and you had leverage. Heinz had already made millions in Montana mining, but he wanted something bigger. So he tried to corner the stock of his own company. Here's how it worked. Some investors were betting that his company's stock would fall. They were short selling, borrowing shares, selling them, and planning to buy them back later at a lower price. If the price dropped, they'd profit. Heinz believed there weren't enough available shares for those short sellers to buy back, so he started buying, quietly, aggressively. If he could control most of the supply, short sellers would panic. They'd be forced to buy at any price just to close their positions. The stock would surge, and he would win. At first, it worked. United Copper stock shot upward. Prices doubled in hours. Traders scrambled to cover positions. It looked like a perfect squeeze. But Heinz made a mistake. He miscalculated how many shares were actually available in the market. There was more supply than he realized. Short sellers weren't trapped. And when buying pressure slowed, even slightly, the stock collapsed, fast. Within days, the entire scheme unraveled. Normally, that would have been the end of it, a failed gamble, an expensive lesson. But this wasn't normal. Because Heinz wasn't operating alone. He had deep ties to New York's financial elite. His associates were connected to powerful trust companies, institutions that functioned like banks but operated with far less regulation. One of the largest was the Knickerbocker Trust Company. When news spread that insiders linked to the failed copper scheme were tied to major financial institutions, confidence cracked. Depositors began withdrawing funds. Lines formed outside offices. And in banking, once a line forms, logic doesn't matter anymore. Within days, the Knickerbocker Trust suspended operations. That's when fear spread beyond a single institution. Banks stopped lending to one another. The stock market fell sharply. Businesses struggled to access short-term credit. The system began to freeze. There was no Federal Reserve in 1907, no central bank to inject emergency liquidity, only private bankers. And one man had enough influence to attempt a rescue, J.P. Morgan. What happened next would reshape American finance forever. When the Knickerbocker Trust Company shut its doors, the damage wasn't contained, it multiplied. In 1907, trust companies operated in a gray area of finance. They looked like banks, they held deposits like banks, they made loans like banks, but they kept smaller cash reserves, and they weren't backed by a central bank. So when depositors rushed to withdraw money, there wasn't enough liquidity to meet demand. That's what a bank run really is. It's not insolvency at first, it's speed. Too many people asking for cash at the same time. Once Knickerbocker failed, other institutions came under suspicion. Rumors spread across New York almost instantly. If one trust company was exposed to reckless speculation, maybe others were too. And when uncertainty enters the system, money stops moving. Banks began refusing short-term loans to one another. That might sound minor, but short-term lending is the oxygen of the financial system. It keeps payrolls funded, it keeps businesses operating, it keeps markets liquid. Without it, everything tightens. The stock market fell sharply. Investors started selling not because they understood the full picture, but because they didn't. Uncertainty drives liquidation. And here's the critical detail. In 1907, the United States did not have the Federal Reserve. There was no lender of last resort. No institution designed to inject emergency cash into the system. If liquidity disappeared, it was gone. Within days, the panic spread beyond New York. Regional banks began pulling funds back from the city. Businesses struggled to access working capital. Even healthy institutions started hoarding cash, afraid they might be next. Confidence wasn't just weakening, it was evaporating. This is how financial systems really fail. Not all at once, but through hesitation, through doubt, through institutions quietly deciding not to trust each other. And that's when one man stepped in. J.P. Morgan was 70 years old. He had already built railroads, financed industrial giants, and shaped American capitalism. Now he faced something different, a full-scale liquidity crisis. Morgan understood something most people didn't. The banks weren't all insolvent, they were afraid. And fear can collapse a system just as effectively as bad debt. So he gathered the most powerful bankers in New York and brought them to his private library. He locked the doors, and he forced them to open their books. Institution by institution, they reviewed balance sheets deep into the night. Some firms were stable and deserved support. Others were too weak to save. Morgan made the calls. Who would receive emergency funding? Who would be allowed to fail? It wasn't democratic, it wasn't public, but it was decisive. Private capital began flowing into struggling institutions. Stronger banks agreed to back weaker ones. Liquidity slowly returned. The stock market stabilized, not because fear vanished, but because leadership appeared. For weeks, the system had teetered on the edge, and it had been rescued not by government policy, but by a private banker acting as a one-man central bank. But the panic of 1907 left a deeper question hanging over the country. What happens next time, when there isn't a J.P. Morgan willing or able to intervene? And that question would lead to one of the most important structural changes in American financial history. The Panic of 1907 ended not because the market healed itself, but because a single banker had stepped in. J.P. Morgan didn't just stop a collapse. He revealed a fundamental truth. Financial systems survive on trust, not on rules, not on capital alone. Trust. Once the panic was over, Congress and economists started asking uncomfortable questions. If the US economy had relied entirely on one man, what would happen when the next panic hit? The answer came soon after. The Federal Reserve System was created in 1913. Its purpose was clear: to act as a lender of last resort, to provide liquidity when fear froze the system, to prevent a single failed gamble from threatening the entire economy. Heinz's copper scheme hadn't just caused panic. It exposed the fragility of American finance. It showed that markets can be manipulated, that confidence is fragile, and that the rules themselves are only as strong as the trust behind them. And that lesson is timeless. Even today, financial markets can collapse faster than policy can react. Trust is everything. And when it disappears, even large, stable systems can teeter. At Empire Economics, we don't just tell you what happened in the past. We show you the systems beneath it, the fragile frameworks that hold economies together, and the lessons we can still learn. Because the Panic of 1907 wasn't just a story about copper or one reckless investor. It was a story about how fragile trust can be, how quickly fear spreads, and why structures matter more than wealth. Thanks for watching Empire Economics. If you want to see more stories that uncover the hidden systems shaping history, make sure to subscribe, and I'll see you in the next story.